right. Thanks everyone for joining us. I hope you can hear me okay. If at any point you can't hear us, just raise your hand or signal something like this, and we'll try to speak. We'll try to speak louder. So I'm really glad to be discussing the real estate finance sector and all the exciting things that have been happening there with John and Nora. Nora Apsel is the co-founder and CEO of Morty, an online mortgage marketplace. And before co-founding Morty, she worked as a software engineer at a number of companies, including Meetup, and she also worked at a nonprofit for a while. And she has a master's in computer and information technology. And then John Lee is the chief operating officer of Divvy, a rent-to-own housing company. And John's been with that company since January, and before joining Divvy, worked in private equity at Blackstone and TPG, and in investment banking at Merrill Lynch. So before we go to the questions, can both of you kind of explain to us what your company does? So Nora, let's start with you. Morty is an online mortgage marketplace. What does that mean? What does it do?
Yeah, and thanks for having us here. I'm excited to have this conversation today. So Morty is an online mortgage marketplace. We leverage great product and tech to first match home buyers with the right home financing product for them, and then we automate and manage the entire experience all the way through closed loan.
And John, explain to us the business model of Divvy, please.
Yeah, happy to. So our mission at Divvy is to make home ownership accessible. So our main product today is a rent-to-own product that is customer-centric. So what we would do is, if you are an aspiring homeowner, you come to us, we'll go shopping with you, and we'll buy the home for your behalf. And we sign a multi-year lease with us, and you build equity to be able to buy that home back from us when you're ready. And we raised $400 million over the last couple of years from Tiger Global, from Andreessen Horowitz, and Caffeinated Capital.
Okay, so neither of you actually worked in real estate or real estate finance before you joined/founded your current companies. So you joined an industry that has a reputation for being very slow to embrace new technology, right? Everyone always says real estate is way behind any other industry when it comes to technology and innovation. Why do you think that is, as someone coming from the outside? What is it about real estate that sort of made it slower to embrace technology than others? Nora, why don't we start with you?
Yeah, it's a great question. So first off, just like a little bit more about my background. So as Konrad mentioned, before I was an engineer, I worked in nonprofit. So my interest has always been around how can we leverage technology to really empower people throughout the country. And so when we founded Morty, Morty is an online mortgage marketplace for democratizing access to home financing solutions. That really resonated with me. What I think I didn't understand when we founded the company was how ingrained the technology was and how inaccessible all of the data was throughout the entire home transaction or home purchase transaction. So the reason why it's been so hard to innovate within real estate or mortgage is because a real estate transaction involves a number of different parties, right? You're talking about a real estate agent, mortgage provider, homeowners insurance, title insurance. All of those people operate in silos without the ability to share or access data. And that means that there's no transparency and there's no accessibility. And the result is then that consumers are confused, they have misinformation, and it's extremely difficult to innovate because nobody's talking to each other.
So John, why do you think that is? Why is this whole space so siloed? Why is it so hard to get people to talk to each other and get good information?
Yeah, no, so I definitely agree with you, Nora, where we joke that we're running 12 different companies at Divvy because for every function of buying a home, we have to innovate. So it's inspection, pricing a home, closing, title. So I think that's what made it hard. But I think the other part of this is that buying a home, especially if you're a first-time homeowner, is a very emotional thing. And a lot of times tech companies go in there and say, we're going to make things really effective, remove the human from it, so that you're doing a transaction on an app. But I think for real estate, that's a lot harder because a lot of times this is their dream to own the home. You're talking about their life savings and their children and their families. So that's been the hardest part of trying to balance it, where you want to be a tech company and innovate, but you recognize that you also need to have a human touch through it all and have the empathy to make sure that they're getting through the transaction will likely be one of the most important transactions in their life.
So both your companies raised a good deal of money in 2021, which actually happened to be, if I'm not mistaken, a record year for fundraising by real estate startups. So last year, 2021, real estate startups raised $12.2 billion, according to CB Insights, which is a ton of money by real estate startup standards. It's like record year by a mile. Since then, it's gotten a little more difficult. Tech stocks are down, real estate stocks are way down, and there seems to be less activity on the fundraising side. So what's your outlook on fundraising by real estate startups? Is the boom over? Was that it? Or do you think this is just a bump in the road? You want to start?
Yeah, so we're definitely seeing that where last year or a year before that, there were a lot of prop tech companies that were going public. There were a lot of companies who were raising capital, as you said, but we're definitely seeing that dry up. I don't have a crystal ball, but I do think that there's a lot of disruptions that will still happen, that needs to happen in real estate. But I think it's just a pause to make sure that when you have that sort of record fundraising environment, you do have a lot of folks who may not have the most viable business model. So I think you're going to see that play out over the next 12 to 18 months. And then I think what you're going to see is the strongest players getting more funding. You're going to see consolidation. And at the end of the day, as we talked about, real estate is a slow-moving industry that needs to be disrupted at some point. And from Divvy's perspective, the affordability, which is what we're trying to really help out and help homeownership accessibility, that still is still there. Affordability is at an all-time high, and we believe that any companies that are out there in the long term that can really help with helping customers and tenants achieve their American dream will get funded. I think the question is when and not if.
Nora, are you looking to raise funding in this environment, or would you rather wait?
I am not looking to raise funding in this environment, but just to sort of jive a little off of what John just said, I totally agree with him. I think we were chatting about this earlier, but the real estate market has dramatically changed over, yes, the past year, but also the past month and the past 2 months. And that opens up an opportunity for a tremendous amount of innovation. People need to, companies that adapt and recognize that affordability is one of the biggest issues and are building innovative products to address that are the ones that are going to get funded. I think like last year we saw interest rates were at an all-time low, and a lot of companies got funded based on that environment. And so I think in challenging environments you see more innovation. So I'm actually super excited to see what happens over the next year around prop tech funding. I don't know what that's going to be, but I think we're going to see some amazing things come from it.
All right, so on the topic of interest rates now, which is since you brought it up, it's the biggest topic in real estate right now. I don't even know where rates are this morning, I haven't checked, but latest numbers from the Mortgage Bankers Association say that applications for home purchase loans are down 37% from a year ago, according to the latest numbers. Interest rates way up, of course, home sales falling. You mentioned that all the changes in the market create opportunity for innovation. Clearly, there's also a real challenge there. So, Nora, let's start with you. How are you, as a mortgage marketplace, coping with this drop in activity? What does it mean for your business?
Yeah, I think the recognition that the environment has changed and what consumers are looking for is different than it was a year ago is really the important part here. So we're a marketplace. We're a home financing marketplace. For last year at this time, I was talking mostly about mortgage. I think, in 6 months, over the past 6 months, that's really evolved. And I think the important thing right now is saying, okay, not all consumers are looking for maybe a home financing, maybe a mortgage to fulfill their dream. Maybe they're looking for a rent-to-own solution. And so for us, in our vision of being able to make sure we can democratize access to home financing solutions, it's about saying, okay, we're in a different place than we are right now. Consumers are looking for a different thing. Let's make sure that we're leveraging product and technology to match those people with what they are looking for and what can serve them best as soon as possible.
So do you view this environment more as a challenge or an opportunity? Does it increase demand for the sort of technology that you offer, or does it make it harder for you to generate business?
It's both. It's a challenge and an opportunity. I think you only get opportunities in challenging moments.
John, so it's been widely reported that Divvy recently laid off 12% of its staff, and your CEO, Adina Heffetz, at the time said, pointed to a volatile and challenging macro environment, which I think is a direct quote.
Yep.
So explain this to us. What is it about the current environment that is challenging for you guys?
So and I don't know how many of you guys are homeowners or looked into buying a house, but a big portion of your monthly payment for a mortgage is your interest rate. So a year ago, people were refinancing at 2%. Now people are refinancing at 6.5% to 7%. So the interest portion has gone up 3 to 4x. And what we're seeing is, I think the actual 7% isn't the issue, where if you look at the history of the US, 7% actually isn't that high relative to where we were 20, 30, 40 years ago. But the speed in which it went up within 3 to 6 months is, and on top of that with inflation and with top of that, potential tenants or customers looking at the news and saying, oh, is there a recession coming? It has kind of paralyzed people from wanting to move, because if you hear all that, why would you want to make a commitment to move? So what we're seeing is that people just don't want to make big commitments right now to move. But what we expect is that things will get better, because that big drop happened as rates went up from 2 to 6%. But things will get better when people feel like the economy is stable and could move. But what we're seeing from our perspective is that our people don't want to move, and we're not in the business of forcing people to move, obviously. And I just think people need some time to understand that we're in a different rate environment.
So people being reluctant to move, clearly one big issue. What about the rental market? So you charge, right, you rent your own business, you charge rent. What are you seeing on that front? Are rents still rising, or are you starting to see them sort of slow down a bit?
So rent is increasing. So if you look at some of the public company rental businesses, they're talking about how on average they're raising rents about 10 to 15%. But what's more important to look at is that includes folks who renewed at a lower rate. So if you actually look at on an apples-to-apples basis to someone that moved, a house that had a tenant and a new tenant comes in, that renewal for that is almost 18 to 20% across the US. And that was June and July. And we're seeing some of that soften, but not at the rate that you're seeing with the mortgage interest rates. Now, from Divvy's perspective, where we see opportunity and where we could be helpful to our customers is that increase in mortgage rates directly impacts affordability, right? As we talked about, your rates will go from 2% to 6%, so it becomes harder for you to be a homeowner. So what we had done in the past was we were getting customers who didn't want a mortgage or who couldn't get a mortgage to come and try our product. But what we're getting now are customers who don't want a mortgage, right? So our message to them is, come with us, we'll buy the home for your behalf, you're being charged market rent, and wait it out, build equity into the home, and when the market is better and the rates are lower, you could be a homeowner as well. So the messaging has changed, and we're seeing that resonate with some folks, but as I said before, it's going to take some time for folks to get used to the higher interest rate and for them to be ready to go buy homes or make a big commitment again.
So waiting it out sounds great, but I guess the question is, how long do we have to wait? So we're in this weird market environment now where prices are pretty high and mortgage rates have gone up like crazy. And if I understand both of you correctly, that means there's just way fewer deals, fewer sales. People are just waiting and seeing. How long do you guys think it'll take until this all shakes out and we're back at some sort of equilibrium where more people buy houses again, more people take out mortgages? Nora, what do you think?
Well, as John said earlier, I don't have a crystal ball, and I think everybody in our industry is avoiding making predictions since this is a new experience, and I think that the speed. John said this already, but the speed at which this change has happened has made it hard to know exactly when people are going to sort of like when we're going to feel a bit more of a calm and comfort, even if it remains in this high interest rate environment. The other thing that's really important, which you mentioned, Konrad, is that inventory of available homes to buy is also at an all-time low. So it's this combination of, should I buy right now? Interest rates are really high, and there's not really even any homes on the market for me to buy. So we're seeing a lot of people exit the market from home buying, and I think summer is peak home buying season, so we're now coming into like a little bit of the off season. But when we come into next year, we'll have to see what happens around home inventory. One big push that's been happening in the market also is a lot of new construction that's being built to allow for an increased amount of inventory. I think as more homes come on the market, it will dramatically help the broader environment.
What are your thoughts, John, on the whole inventory point? Do you think there is any shift happening here where we might have a more affordable housing market going forward, more supply, or do you think the issue is basically going to remain the one it is now?
Yeah, I'll tell you what we're seeing. It's hard to predict, but what we're seeing is this is different from 2008 and 2009, right? So the reason why the housing market corrected so quickly in 2009 and 2010 is because you saw a wave of foreclosures and forced sellers who had mortgages that were underwater. And we're not seeing that at the moment. And when you don't have folks that have to sell, and when you have folks that don't want to buy either, you kind of get into a stalemate. And our view is that we are preparing for the worst, which is this may be a multi-year thing, and which is why, unfortunately, we had to do a layoff a couple of weeks ago. But I'm also hoping for the best. But just running a business, we just have to assume that it's going to be bad for a while, retrench, think about where we could invest, and think about how we could be better coming out of it, and while still providing great customer service. But I just think that it's going to be a stalemate for a while because people aren't forced to sell, and people don't want to buy, which is a different market, whereas in 2009, it just everything corrected very quickly because people were forced to sell. But we're not seeing that today.
Nora, I want to talk about the inventory a bit more because I think it's a really important point. There's clearly a ton of reasons why there isn't enough housing inventory, why not enough housing is being built. One argument that some economists have made more recently, is that big investment firms getting into the housing market and buying up houses reduces the inventory of homes for sale, right? So the argument is basically giant private equity companies buy up all these houses and basically outbid individuals like me or like yourselves who then can't find houses they can afford anymore. That's the argument. Now, what do you guys think? I know it's sort of a fraught topic, but what is, in your mind, what is the impact of this influx of investors in the housing market? Has that actually had an impact on housing affordability? Is it having an impact, or is it sort of overblown? Whoever wants to start.
I'm happy to go first. So I do think it's important to parse out what people mean by real estate investors. So if you look at some of the data that's been being quoted, they don't distinguish between mom and pop investors and the institutional investors, right? So if you own 3 or 4 homes, a lot of the news that's out there includes that in the percentage that's being quoted. So it's unclear to me if that should be different, but at least the way I look at it, we look at the institutional buyers who are the big public companies that own 10 or 20,000 homes. So if you actually look at that data, they currently own less than 2% of the homes that are out there. They buy less than 20% or 15% of homes per year. And what we've seen in the last couple months is that they're not buying. So they've actually paused along with a lot of the individuals out there when the rates went up, because they're also borrowing money to buy these homes. So long way of saying, one, it may be, but I think what you should be looking at is the percentage of homes that are being owned by institutional investors, and I think it's a lot less than what's actually being reported. But then two, we'll know soon because they stop buying, so then we'll be able to see how the world changes when the investors stop buying. But to me, generally, I think balance is good. I think everything is good, and if there's a balance. And do I think 0 is good? No. Do I think 100 is good? No. Right? I think there's a balance to that, and I think what they also provide a lot of times is that for the retiree that wants to sell their home, right, they're also able to provide liquidity to those individuals as well. So everything's a balance. I don't think it's as bad as is being reported, but we'll see in the next few months because they stop buying.
Yeah. Nora, what do you think? I mean, a big part of your business is helping individuals get the financing to be able to buy a house. Do you find that it's getting harder for them to compete against big investors, or would that be too simple?
The home buyers that we work with, it's if they're losing out on a home, it's usually to somebody who is bidding 10, 20% over asking. It's not necessarily from an institutional investor. So I think like John's read on that market is probably pretty right on. I do think that we have started to see home prices come down for the first time, I don't know, in recent memory. And so I do think that there are a lot of market factors that are happening right now that are moving in the right direction. But the question still stands of like, how long is it going to take for the storm to pass to make this stuff more accessible, right? And especially more accessible to first-time home buyers who are looking to buy what's classically considered like a starter home, and maybe has less money for a down payment because they're not selling something right now. And so the trend of new construction combined with decreasing home pricing is a positive trend for me, but like I do think that doesn't necessarily mean that I think that this is going to be over in the shortly. I think we have some time that we have to wait it out.
All right, so we have about 2 minutes left, which I guess means this will be the final question. John, you made a really interesting point earlier. You made the point that there is this human need for a human in the real estate interaction, in the real estate transaction, that buying a house is a really important big step for people, and that they like to have a broker or an attorney in there who sort of holds their hand and walks them through it. We don't have a crystal ball, but if you were to bet, is that ever going to change in the future? And that's a question for both of you, because you're both in this space. Is this central role of the human being, the middleman, middlewoman, in the real estate transaction, is that ever going to go away? Is it ever going to be replaced by technology, or is that here to stay?
Yeah, I personally don't believe in the one-click buy a house, one-click sell a house concept, and it's just an emotional purchase, and it's more than a purchase a lot of times. And the way we do it is we rely on our agents and our customer support team to supplement the technology, and I just don't see the human element of it, because it's such a human, emotional-driven purchase, that piece goes away in the long term.
What do you think?
I agree. I think real estate is inherently local, and for us, technology and great product really provides the role of like transparency, accurate data, knowing exactly what's going on at every single moment, and being able to connect all the different parties. But like as John was saying, this is not just a purchase; it's for many people like a life stage. And being able, even if you never call them, right, being able to know that there is somebody that is behind the product or the technology is extremely important.
All right, we have exactly 15 seconds left, so we timed it well. Thanks so much, John. Thanks, Nora, for taking the time to chat, and thanks to all of you for listening.